All right. Hello, everybody. I am Michael Schneider. I'm a wealth advisor with the Learner Group. And today I'm joined with J.R. Gondek, Managing Director and Partner of the Learner Group as well. And today we are going to recap the markets that we saw in February and give our outlook for what we see moving ahead. Now, J.R., one thing we did see in February was some pullback towards the end of the month within the equity markets. But overall, we were up at the end of the day. The one area we did see weakness was within the bond markets, as we did see a rise in interest rates. And generally speaking, we do see two reasons for a rise in rates. One is going to be inflation concerns, and the other is economic prosperity. And obviously, that's going to be a great thing for everyone involved. Now, we have seen one of the steeper yield curves that we have seen in a long time. Now, that tends to be a positive sign for markets and just economic prosperity. However, we could say that if rates do continue to rise, that could slow down economic growth. Do you think that's a valid concern to have?
Yeah, the jump in interest rates, as we saw the last few weeks, and it's really been a 7-month trend from the lows of interest rates last summer. But if rates move too fast, you could see the implications. It could hurt the housing market. Mortgage rates go up. It could hurt lending and auto loans. Everything could hurt the consumer with interest rates going up too fast. Now, many of you listening can think historically that interest rates are still very, very low by any historical measure. But now when you look to why we're not as concerned as that rates will continue to go up is the Fed. The Fed's due to meet again in the middle of March. And what to watch for in the Fed, we believe that the Fed could extend duration, right? When you look at the Fed has historically had a dual mandate, full employment and to control inflation. And when you look currently, they're laser focused on the 10 million people that still have not come back or fully recovered their jobs. And interest rates going up too fast could really hurt the job market in many of the areas that are tied to interest rates going up overall. So if the Fed were to extend duration, they could buy longer term bonds and hold the interest rates from going too far too fast. So that's something we believe the Fed would consider if interest rates go up. So it's not something we're too concerned about, even though it could be a big problem if rates went up too much from here.
Okay. And one other thing we wanted to talk about was commodities. And lately we've been seeing prices of commodities just really increase dramatically, whether it's oil, steel, copper, lumber. How do these price moves really impact inflation and the economy as a whole?
It's something we've been watching the last 6 or 7 months with the rise of activity. Everybody's trying to stimulate at the same time to get out worldwide out of the pandemic, the shutdown, terrible year we've all went through in the last year. Now, when you turn specifically to the housing market, especially in the US, with interest rates down, with a new trend unfolding within the housing market, there's huge demand for construction and housing overall. So when you think about building a house, lumber prices are up dramatically, copper prices are up, steel prices are up, iron ore prices are up. And as we think ahead, Michael, I don't have to look further than you and your family looking to move from the city to the suburbs, right? What's your feeling? Is this a new trend? Are you an anomaly that and this will just be a 1-year blip along the way? Or is this a new cycle as new families are starting and leaving the cities for the suburbs?
I personally would love it to be a blip because that means I'm the only demand and a lot of supply. But unfortunately, I just don't think that's the case. Between my wife and I and our son, and we've got a lot of other friends that are moving out to the suburbs right now. The demand is just there. If there is a house listed for more than a month, there's usually something wrong with it. Maybe it's priced too high or something along those lines. But things get gobbled up pretty quickly. And one other interesting thing that we have noticed about this new trend in people moving is that people are looking for their forever home immediately. They're not looking for any type of starter home out in the suburbs. They're looking to spend larger dollar amounts, get the larger house, get have newer appliances, and really only look to move once. And that's something that I think is definitely a change from what we had seen over the last probably 10, 15 years.
And when you think of the reason why, I mean, millennials generally have started 5 or 6 years later is what a lot of the data shows. And what the pandemic did, and it appears, is accelerate or start that new cycle. So if you really get through this multi-year trend of what Michael's talking about, you could see this unfold for another 3 to 5 years at least ahead. And again, the new purchase of appliances, all the demand that goes in with moving or building, and the activity is just positive for the overall economy, both short and long term. And again, back to that interest rates, it's a reason the Fed does not want to see interest rates go too fast to the upside.
Mm-hmm. Okay. And as we look towards sort of our general outlook towards the economy, if we're looking at with the Fed continuing to print about 120 billion a month, keeping rates at zero, and as we look at the vaccine output increasing, can you, JR, talk a little bit about what you see, really for moving forward?
We've seen too many corrections, as Michael started the conversation, in January and February. We believe you could see a lot of these mini corrections along the way this year. And what we continue to use those corrections are as an opportunity to rebalance. And the other thing you're going to see this month and into tax season, it's the 1 year anniversary of the lows from last year. So any asset investors bought in March of last year is becoming from a short-term gain to a long-term gain. And we in many portfolios are going to take some of that opportunity to get long-term to rebalance as well. And you continue to see a rotation within the market. So the large companies are up 1 or 2% on the year, whereas the smaller companies are up double digits on the year. And it just is rational for the cycle we believe we're in to see a rotation. It's not as if the big companies are bad. There's just better opportunities overall. And we think you'll see a lot of these mini corrections throughout the year. But again, as long as the Fed maintains printing 120 billion, we believe you'll see a good year for equities selectively. And we continue to watch for those good values and rotation overall.
Very good, very good. Well, I certainly hope that's the case. So with that in mind, I'd like to thank everybody for joining us, and we look forward to seeing you all next month.